The Dow has dropped 5% since early October, the S&P 500 5.3%. The Nasdaq lost 8% since the end of August. And the Russell 2000, which covers small caps and got through the February sell-off with barely a dip and then surged again, is down 11% since the end of August. These are just small declines, so it seems no reason for concern. But once you look under the cover or venture further afield, it's not so pretty anymore, with many big losers among large US stocks and entire markets unwinding abroad. So what's going on that we're not seeing in the Dow, and why does this smell different? I'm Wolf Richter of WOLFSTREET.com, and this is the Wolf Street Report. The German DAX is down about 15% from its peak in January 2018. Germany has the largest trade surplus of any country in the world, a combination of the highest exports behind China, but fewer imports. But now those exports are under threat from the US-China trade dispute and to a lesser extent from the US-EU trade disputes. German shares had more than doubled since 2011, and so you can double only so many times before you have to pay the piper. The London Stock Exchange is down about 11% since May. Brexit is the big topic there, and no one knows how this is going to turn out. Italian stocks are down 22% since May. A new government, a new debt crisis. Italian government debt is getting beaten down. Banks are still in trouble, those that didn't collapse last year, and uncertainty reigns. China's Shanghai Stock Exchange Index is down nearly 30% from January and 50% from the 2015 bubble peak. The Nikkei is down 7% since the beginning of October. And that's my special favorite because it remains down about 42% from its bubble peak in 1989. There has been little inflation in Japan, so inflation wasn't around to cover up the mess. Among US automakers, it has been Carmageddon. GM is down over 30% from a year ago. Ford is down 50% from 2013 and down 78% from the $38 range in the late 1990s. In the financial crisis, Ford was the only one of the 3 US automakers that didn't file for bankruptcy, but its shares still dropped below $2 a share. Fiat Chrysler is down 38% since late January. Tesla is down 31% since Musk's funding secured tweet of August 7th. Then there are other big companies that are getting crushed. IBM is down 24% since late January and down 33% since 2014. GE is coming unglued. It's down 60% since early 2017. And here the deal is that when you dismember a conglomerate that includes a mix of industrial companies and a financial empire, along with a huge amount of debt, even during the best of times with the highest asset prices around, then what's left at the end may not be able to survive. And it's always a lot more fun on the way up, but when you're unraveling a conglomerate, it's a nightmare. There are a lot of big companies like these, once proud names, that have gotten crushed. Among the S&P 500 companies, over half of the stocks are down at least 20%, and over 70 are down over 50% from their all-time highs. Then, of course, there are the Fangman stocks: Facebook, Amazon, Netflix, Google's parent Alphabet, Microsoft, Apple, and Nvidia. Combined market cap of $4.2 trillion just among 7 stocks. When you imagine this is somewhere between the GDP of Germany and Japan. All of them have taken a licking recently after having soared in an inexplicable manner for years. But Facebook is the big loser among them, down 29% since July. Amazon and Alphabet are also taking it on the chin. They're down about 14%. Now, when you're talking about a market cap of $1 trillion, as in Amazon's case, at its peak, that 14% decline represents $114 billion that has gone up in smoke. Of course, some stocks are rising and have hit new 52-week highs, so it's not all red on your screen, and that's why the Dow and the S&P 500 as an overall index are down relatively small percentages at this point. But while all this is going on, there has been no quote-unquote flight to quality. when things begin to deteriorate in riskier assets such as stocks or junk bonds, treasuries often become sought after, and the prices of those treasury securities rise and yields fall. But the 10-year treasury yield on Friday was 3.2%, very close to the multi-year peak in early October of 3.23%, which had been the highest since July 2011. And the 2-year yield on Friday rose to 2.92%, the highest since June 2008. So the yields are still rising, and they're behaving as if investors are not particularly looking for a safe asset. So there is no flight to quality. And investors are still seeking risk in the U.S. While high-grade corporate bonds have sold off hard and medium-grade bonds have sold off too, the riskiest end of the junk bond market has outperformed all of them. The CCC-rated average yield, so that's in the rating scales, the bottom end of it before D rating, which is default, in the average yield of these bonds was just over 10%. And giving it a spread to U.S. Treasuries of about 7 percentage points. That's the lowest spread since 2014. During the oil bust, the spread surged to 20 percentage points, and during the financial crisis, the spread surged to 40 percentage points. So these are high-risk bonds. They have a significant chance of default, and investors take very big risks, normally for very high returns. But at this point, investors are still chasing yield. They're taking huge risks in the bond market without much compensation, and they're very sanguine about this. So what does that tell me? For now, no one is taking the sell-off seriously. Calm reigns. There's no panic anywhere. So this smells differently. It smells of a market that is too confident, a market that is brushing off the Fed's tightening and what higher interest rates will do to corporate America, consumers, and housing. This is a very risky situation because the mindset in the US has a lot of room to change. But I still don't see any signs that a big crash is somehow setting up. I think this will be a situation where the declines will be relatively small, interrupted by upticks, but they will accumulate. And over time, this will turn into a fairly long, drawn-out sell-off that will spread across all markets. So not just stocks, but bonds, junk bonds, especially junk bonds and their sisters, leveraged loans. These are instruments that are issued by companies that have junk credit ratings. They're fairly high risk under normal times, and when the economy gets into a slowdown, these become very unpalatable. The default risks are large, and when defaults occur, especially with junk bonds, the losses for investors can be magnificent. There are a lot of junk-rated companies that are top brand names, such as Tesla or Netflix, and that have negative cash flow, that constantly need to borrow new money in order to operate. And when the junk bond market tightens on them, they may not be able to borrow any more money. This will turn off the money spigot, and these companies will have trouble continuing. That's how defaults happen. They happen because these companies run out of money and can't pay off their existing debts with money they've raised from issuing new debts. But the junk bond market is still a million miles away from it. Leveraged loans are hot. Collateralized loan obligations, which is what leveraged loans are turned into oftentimes, are hot. Junk bonds are hot at the riskiest end, even though at the less risky end, they're starting to lose their allure. So at this point, investors are chasing yield. They don't really care at this point about the risk of default. And that makes this market very, very risky. Since a lot of these companies are publicly traded, stocks are heavily impacted by the junk bond market. And so far, far, the junk bond market has supported the stock market, but once that prop from those junk bonds and leveraged loans gets pulled out from under the stock market, and you got to keep in mind the numbers. Junk bond market in the United States is over $1.2 trillion, and the leveraged loan market is even bigger. So you're looking at over $2 trillion in funding that suddenly gets very scarce. So when this gets pulled out from under the stock market, then stocks venture into a new era as well, where chasing yield just is no longer cool. And that's the risk all asset classes face after 8 years of asset price inflation. I'm Wolf Richter of WOLFSTREET.com, and this is the Wolf Street Report.